Hi, welcome back. We'll be looking at part 3 of chapter 11. All right, retained earnings. You learned about retained earnings in the first or second chapter of the textbook. It's net income that a company retains for use in the business. Retained earnings is not cash. If you think of that T account retained earnings, and we're going to look at it in a minute, net income increases retained earnings and net loss decreases retained earnings. Retained earnings is part of the stockholders' claim on the total assets of the corporation. And if retained earnings goes into a debit balance, that means the company has experienced losses. There are restrictions on retained earnings. There are legal restrictions, there's contractual restrictions, there's voluntary restrictions. And when companies put restrictions on retained earnings, they're essentially saying these are not available for payout as dividends. And most often companies will stop and say, we want to protect some of these retained earnings as a signal to the stockholders that we want to do a build out, a capital expansion, whatever, but it's just not available for dividends. Okay, prior period adjustments, corrections. Companies make mistakes, and as we look at financial statements and 10-Ks, you're going to see that often they'll recast statements from year to year. They may make math errors. They may misinterpret accounting rules. They may just commit gross errors or misuse of facts. And so corrections are treated as prior period adjustments. If they make huge errors, they have to recast the whole statements. But for smaller errors, they do prior period adjustments, and they make those corrections to the beginning balance of retained earnings. So let's take a statement of retained earnings for Butters Company, Butters Inc. Beginning balance, as a review, beginning balance plus net income minus dividends equals ending balance. Okay, before issuing the report for the year, you discover a $50,000 error on the inventory. This caused 2010 inventory to be overstated, which caused cost of goods sold to be understated, and net income was reported higher than it should have been in 2010. So for 2011, we want to adjust that 50,000, and this is how it looks. Beginning balance, adjustment, which would reduce. Remember, that's a loss. We overstated profit in the prior year, so we're reducing retained earnings, and our balance here is going to be 50,000 lower. Okay. As a review, this is the retained earnings T account. Note on the left side, or the debit side, I'm showing that in pink because it reduces retained earnings. Retained earnings normal balance is a credit. Retained earnings is increased by net income. It's also increased by any prior period adjustments for understatements of net income. Retained earnings is it decreased by net losses. It is decreased for prior period adjustments of overstatements of net income like we just did. It's decreased by dividends, and it's possibly decreased by sales of treasury stock if necessary, as we saw in part 2. Last slide on here is the calculation of ROE. We call this return on common stockholders' equity, ROE, net income available to common stockholders divided by average common shareholders' equity. This ratio shows how many dollars of net income the company earned for each dollar invested by the common stockholders. Okay. Following are solutions to problems, and I will let you look at those at your leisure.